One of the tools that accountants can use to help prepare the financial statements is the worksheet. The worksheet has 11 columns that are used to record the adjusting entries, calculate an adjusted trial balance, and then calculate net income. The worksheet title contains the company name on the first line, worksheet on the second line, and the month ending date on the third line. The same is for many other financial statements. If we look at a worksheet, the first column contains the account names. Notice we record them in order of assets, liabilities, owner's equity, revenues, and then expenses. The next two columns contain the trial balance amounts for each account taken directly from the general ledger after the final transactions for the accounting period have been recorded, but before the adjusting entries are journalized and posted. Once they are recorded on the worksheet, we total the debits and then the credits and compare them to make sure they balance. This is where you would catch transpositions, amounts in the wrong column, or missing. The next two columns are for the adjustments. Let's record the same adjustments we just calculated. For prepaid expenses, we had two adjusting entries. The first adjustment is for supplies. We record $300 on the supplies expense line in the debit column and $300 on the supplies line in the credit column. The next entry is a debit for $250 to depreciation expense and a credit to accumulated depreciation equipment. For accrued expenses, we are recording the unpaid wages, so it is debit to wages expense for $160 and a credit to wages payable for the same amount. For accrued revenues, we are recording the interest we have earned, but that has not been paid to us yet. The adjusting entry is a debit to interest receivable for $10 and a credit to interest income for $10. We also had two adjusting entries for unearned revenues. The first adjustment is to record the revenue we earned on the gym membership for 1 month. We debit unearned revenue for $75 and credit revenue for $75. Remember, we had originally recorded the revenue in the unearned revenue account, so the process is to adjust the amount we earn each month. The second entry is to record the unearned revenue for work we did not complete on the log tables. We originally recorded the customer payment as revenue, so the unearned portion must be adjusted. We debit revenue for $600 and credit unearned revenue for the same amount. Once all the adjusting entries have been recorded on the worksheet, we total the debits and then the credits to make sure they balance. Next, we calculate the adjusted trial balance in the next two columns. If the account has no adjusting entry, like cash, you just bring the unadjusted amount over to the same column, debit or credit, in the adjusted trial balance. When we get to supplies, there is a debit balance and a credit adjustment. So you would subtract the credit from the debit, and the result of $200 would be recorded in the debit column. If there is no entry in the trial balance column, as is the case with interest receivable, you would just add the adjustment of $10 to zero and record it as a debit in the adjusted trial balance column. As we move down the worksheet, we come to accumulated depreciation equipment, which has a credit balance and a credit adjustment. You add them together since they are both credits and record $1,000 in the credit column. The next calculation is for unearned revenue, where we have a credit balance of $900 and two adjustments, a debit of $75 and a credit of $600. Since the credit is larger, you would calculate the adjusted balance as 900 minus 75 plus 600 equals 1,425, which is recorded in the credit column. Revenue will be calculated as 7,400 minus 600 plus 75 equals 6,875 in the credit column. After we finish recording the adjusted trial balance amounts for all the accounts, we sum the total debits and make sure they equal the total credits. The next step is to record the adjusted balance for each account in the financial statement column where the account is reported. Assets, liabilities, and owner's equity accounts go to the balance sheet columns, and the revenues and expenses in the income statement columns. Once everything has been recorded in one of the financial statement columns, total all the columns, noting that this time the debits will not equal the credits. So if we look at the income statement columns, the total debits represent the total expenses, and the total credits represent total revenues. Subtract the smaller from the larger, and record the result in the column with the smaller total. In this case, the debits total $5,260 and the credits total $6,885. The difference is $1,625, which represents net income. Record the $1,625 in the debit column and then total debits and credits again. Since the $1,625 was recorded as a debit in the income statement columns, record the same amount as a credit in the balance sheet columns. Total the debits and the credits in the balance sheet columns again, and they should also balance at $20,390. If you remember the closing process, you credit the owner's equity account for the revenues minus the expenses in the income summary account, so that is why the same amount balances in the balance sheet columns. From here, you would create the financial statements, starting with the income statement, then the statement of owner's equity, and finally the balance sheet, all using the numbers in the last four columns of the worksheet.